From the moment that people find out that you're looking to purchase your first home, it's like everyone comes out of the woodwork, from your family, your friends, your coworkers, and heck, and even that person that's across the office from you that you've never seen, never spoken to, got word that you're getting ready to buy a home, and now they're coming in with some help too, right? Don't worry, it's completely normal. Just tell them thank you. As you're getting all that wonderful advice coming in from everybody, let's go ahead and talk about 6 mortgage myths that you can ignore right now and just balance out the information you're getting in between you and your trusted real estate advisor and you and your local loan officer. My name is Andrew Finney, your real estate geek. If you need help finding a top agent where you live, or if you simply want to drop me a line to say hello, my contact info is below. If you're new here, please go ahead and subscribe to this channel now and like this video. Tap the bell icon to get notified of the next one. Thank you. Okay, team, let's take a closer look at this. There's 6 very specific mortgage myths that you can ignore right now. The first one is, if you have little or no credit, you can't buy a home. Yes and no, and maybe so. It really all depends on what's going on. There's such an animal that's called alternative credit. Some lenders may be able to provide you different forms of alternative credit. So think of that as your monthly bills. Do you pay them reliably? What monthly bills do you have? And which ones can be documented as a payment history? Now, obviously, a really easy one to think of right off the top is if you're currently renting. That's something that you're easily paying. You're paying by check, you're paying by direct deposit, whatever the case may be, you're paying a rent of some sort, right? So you can even get a verification of rent that's being completed by your landlord, 24 months of canceled checks. There's a lot of different things. Oh, geez, for that rental, we also need these things called utilities. So you can actually look at your utility bills and provide those to your local loan officer as well. They'll look at your gas, your electric, your cell phone, your cable bills that can all be documented with online history that shows on-time payments. With those bills in hand, you can get with your mortgage broker and they can call the credit agency and ask the service provider to confirm your history is accurate and actually include it into your credit report. Having those in your credit report, needless to say, is going to help boost your credit score from whatever it is right now, whether you have a little one or a no credit. So having something is going to be really good. Now, it is important to note that not all lenders can accept alternative credit, but some might be able to. Just chat it over with your mortgage broker and see if they're going to be able to do that, okay? Let's move on to the second myth. Bad credit kills your chances of getting a mortgage. That's not always the case. You do need to demonstrate that you do have the ability and willingness to pay your debts, and that's not unreasonable. You're asking for hundreds of thousands of dollars to buy a home. Obviously, they want to make sure that you're going to repay your debts that you agree to, right? And the way that lenders look at this is they look at how you have treated your past monthly debts from everything we were just talking about underneath point 1. Have you fulfilled your debt obligations? The easiest way is to look at your credit report. That's why your credit report always comes into play, to make sure that you're reliably paying your debt obligations that you've agreed to. What happens if you haven't always been perfect? Any lender can work with a few light bruises, and some lenders might not only work with heavily bruised credit, but specialize in it. So it's important to note that every local loan officer has a different niche, and some of them have these nice, easy to go niches, and some of them actually specialize in helping people with awful credit get approved for a home loan. It is important to note that those mortgage brokers, you might be paying a little bit more or a lot more to, depending on what the situation is. But if you want to buy a home, you might have the option to do it by working with one of them. Owning your home and paying your mortgage on time will help you get a better loan later, and it'll also boost your credit score now. The third myth is that a loan pre-approval is a loan guarantee. That's not always the case. A pre-approval means that someone has reviewed your documentation, being your income, your assets, your credit, and verified your employment. With your income, they took a look at your last 2 years tax returns, they looked at 2 months of your bank statements, they looked at 1 month of your pay stubs, verified your credit report was good to go, and that you have a job, right? Now, that's basic lender criteria. However, it's also based on the snapshot in time that you provided that information to the local loan officer. So in between that snapshot in time, what can change? Well, there's 4 reasons that this can change. The first one is your employment can. If you transfer jobs and you transferred out of an industry, you transferred into a new one, you got fired, you got hired, you're earning more, you're earning less, whatever the case may be, your employment can change, and it can also change your loan pre-approval letter. The second one is for people that have a lot of money in the stock market or a lot of investments, that if you hold stock, your available cash could disappear very, very, very quickly if you were counting on the stock market to provide you with the cash to purchase your home. The third one is underwriting changes go on all the time. So their guidelines change from time to time. So you might be pre-approved for something in the current underwriting guidelines, but it could change if a different set of guidelines came up when you got ready to actually purchase your new home. It's one of the reasons to make sure that when you get your loan pre-approval, it's time to go into home shopping mode ASAP to make sure that those loan guidelines don't change. The fourth thing is interest rates could rise before you have a chance to purchase your home. If interest rates rise, and let's say they go up by like 1/4% or 0.5%, it could be the difference of you being pre-approved at $400,000 and being pre-approved for $375,000. If you had your heart set on a house that was at $300,000 $390,000, now you're left in between a rock and a hard place because you can't get more loan than $375 in this example. It's important to think about how that affects you, okay? The fourth myth is that you must pay your taxes and insurance with your mortgage. It's something that most of us do. We find it very, very easy to let the lender handle through the escrow account and pay the county the property taxes and pay the homeowner's insurance for us. At the same time, some people might like to do that themselves. Some people might like to let that money mature in their account and earn some interest on it. So if you've put down 20% or more on your home loan, an escrow account is not necessarily required. So it's something that you have the option to pay off to the side if you wish to do so. As a pro tip, it is extremely smart to pay your property taxes and homeowner's insurance along with your mortgage. Those are two things that I've seen sometimes in preliminary title reports when people go back to sell their home, that they now have a lien against their home because they failed to pay their property taxes or they failed to pay their homeowner's insurance, and now they're in a little bit of a bind. Just letting the mortgage company take care of it directly and paying that your principal, your interest, property taxes, and homeowner's insurance with them is very, very helpful. It just simplifies the process. At the end of the day, it's your choice, it's your call if you put 20% down or more on your mortgage. The fifth myth is that student loans will prevent you from being able to buy a home, but that might not be right. There are other options available, and in fact, what lenders often do is they look at your total monthly obligations. As long as it doesn't exceed a certain percentage of your gross income, which goes in the debt to income ratios, right? I've made a video about that if you want to know more about how debt to income ratios work, by the way. So if your debt to income ratio is under that ceiling, you're probably going to be okay. Some lenders might be able to roll your student loans in with your mortgage, reducing your total monthly payments to help you qualify. Now, not every lender can do that. Some can, some can't. It's something to discuss. If it's something of interest to you, weigh out the pros and cons and get the straight scoop directly from a local loan officer on that. Make sure that if you choose to roll in your student loans with your mortgage, if that lender can do it, you want to know the pros and cons to make sure it's the best thing for you. The sixth myth is that the payment on adjustable rate mortgages will jump sky high at the end of its term. Here's the deal. Banks can't just make up an interest rate at the end of that term of the adjustable rate mortgage and say, hey, you know what? We had a 5%, it's 5 years later. The market rate right now is at 7%, but we're going to slap you with 10%. No, wrong. They can't do that. Oftentimes this is determined by taking the market interest rate, also known as the index, and the bank adding a certain margin to it, and the margin would be dictated in your contract that you agreed to for that adjustable rate mortgage. Now let's give you a real world example of how this might work. Let's say that you have a friend that used an adjustable rate mortgage 5 years ago, and let's say that they got their rate at like 3.5% back then, and now their adjustable rate mortgage is coming due. Now let's say in today's market the rate's around 5%. That means that their rate's more than likely going to be very close, around 5%, now that their adjustable rate mortgages come due. So even though we can't predict where market interest rates are going to be in the future, what we can predict is that it's going to be somewhere in line with whatever the average interest rates are at that time at the end of the adjustable rate mortgage. Something to think about, something to consider. As a pro tip, a lot of people find a 15-year or 30-year fixed rate mortgage extremely helpful. It's up to you how that's going to apply. Review your options with a local loan officer. Make the best decision that's right for you and your family. And understand the pros and cons of each at the end of the day so that you feel comfortable and confident every step of the way. Now here's what I'd like you to do is share your comments with us in the comment section below about any other myths that you know that we should be watching out for, and which one of these really stuck out to you the most. Tell us about it in the comment section below. I'm going to go ahead and pop up my contact information. If you simply want to drop me a line to say hello, or if you need help finding a top agent where you live, please let me know. Always love to hear from you, and I'm always here to help you. If you haven't already done so, I'm going to ask you to do 3 things. Number 1, please subscribe to this channel. Number 2, please like this video. Number 3, please share this video around with someone you know is going to be a help, because someone just like you is wondering what are the myths from the facts as it pertains to mortgage, and what should I know, and can I get the straight scoop, please, right? Share it with them. Thank you. In between now and next time, I'm wishing you and yours a lifetime full of love, wealth, abundance, and happiness. Thank you for watching today, team, and enjoy an amazing day.